My dear students, I am Dr. Harblas Heera, Associate Professor at City Government College Ludhiana. I shall discuss with you regarding the corporate accounting subject in which we shall discuss accounts of banking companies. This is syllabus, we always discuss it, and the corporate accounting in unit 2 there is accounts of banking companies. In previous lecture, we had discussed Banking Regulation Act 1949, different sections, Schedule 3 format of profit and loss account of banking companies, schedules and problem solving. Now, today we shall discuss with you balance sheet that is covered under Schedule 3 in the format of the balance sheet of banking companies in Form A. We know that there are 12 schedules. Schedule 1 to 5 are related to the capital and liabilities, and from 6 to 12 relating to the assets. This is schedule 1 capital. So for nationalized banks, for banks incorporated outside India, for other banks. So we will be providing the information regarding the capital of the banking companies. And there is schedule 2 reserve and surpluses, statutory reserve, capital reserve, share premium, revenue and other reserves, and balance in profit and loss and the total. In schedule 3 there are deposits, different deposits and the total of it. And borrowings, Reserve Bank of India, other banks, other institutions, and borrowings outside India. In schedule 5 other liabilities and provisions, bills payable, inter-office adjustments, interest accrued, others. And schedule 6 cash and balance with the Reserve Bank of India, cash in hand, balance with the Reserve Bank of India in current account, in other accounts. So we have to maintain a balance with the Reserve Bank of India. And in schedule 7 balances with the banks, money at call and short notice in India, outside India. And investments in India and investments outside India in different securities or government securities, approved securities, shares, debentures, bonds, subsidiaries, etc. And schedule 9 advances. So there are 5 sections. Schedule 9, A section, B section, C section, and further there are part 1 and 2, and the total of it: bills purchased and discounted, cash credits, overdrafts and loans, repayable on demand, secured by tangible assets, covered by banks, unsecured. So we will be providing information regarding the advances. And in schedule 10 it is fixed assets, premises, other fixed assets, the cost, additions, reductions, depreciation, and the balance. In schedule 11 other assets, inter-office adjustments, interest accrued, tax paid in advance, stationery and stamps, non-banking assets acquired, and some footnotes. And in schedule 12 there are contingent liabilities, claims against banks not acknowledged as debts, liability for partly paid investments, liability on account of outstanding forward exchange contracts, guarantees given on behalf of constituents in India, outside India, acceptance, endorsement, and other obligations, other items for which bank is contingently liable. So these are the 12 schedules, and we will be putting all informations relating to the question in these schedules, and we will summarize. This will be the solution of the answer. Now we shall discuss a case, that is a case of a bank, and there is trial balance, debit balances, and credit balances. Cash credit, current accounts, cash in hand, cash with RBI, cash with other banks, money at call, gold, government securities, premises, furniture, term loans. Similarly, share capital, statutory reserve, non net profit before appropriations, profit and loss, fixed deposit account, saving deposit account, current accounts, bills payable, borrowings from other banks, and there are certain other informations: bills for collection, acceptance and endorsement, claims against banks not acknowledged as debt, depreciation charges, premises, furniture, and there are certain conditions. 50% term loans are secured by the government's guarantees, 10% cash credits are unsecured, cash reserves required, 3% of demand and time liabilities, liquid reserve required 30% of the demand and time liabilities. So we have to prepare the balance sheet from this data. So for this we have to recognize which information belongs to which schedule. So we'll be apportioning, or we will be assigning that information to a particular schedule to which this information belongs. Uh, for example, current accounts overdraft, this is schedule 9. Cash credits, this is schedule 9. Cash in hand, this is 6. Cash with other banks, 6. Cash with RBI, cash with other banks, 7. Money at call, 7. Gold, 8. Government securities, 8. Premises, 10. Furniture, 10. Term loans, 9. Share capital, 1. Statutory reserve, 2. Net profit before appropriation, 2. Profit and loss, 2. Fixed deposits, 3. Saving deposits account, 3. Current accounts, 3. Bills payable, 5. Borrowings from other banks, 4. So we have to recognize which information belongs to which schedule. Now we will be summarizing according to the schedule 1 to 12. This will be like this. So this is according to schedule 3 of the Banking Regulation Act in the form A. So there is capital and liabilities and assets. Share capital, the data is given, we just have put in different schedules. For example, share capital in case of schedule 1, this is 99 lakh. So in case of reserve and surpluses, this is like this. The data we have filled, and the total is 396. There is statutory reserve, the opening balance additions during the year. So there is addition of 18.75 we will be calculating. So this is 18.75 is like this, that in the profit and loss given before appropriation 75 plus balance of the profit 206, total becomes 281, and there is statutory reserve we have to transfer, that is 18.75, 25% of 75. So the balance is 262.25. And similarly, there is balance in profit and loss account. So we will be making adjustments in the profit and loss account also. There is 262.25, that is like this, we have already calculated. Now in next schedule 3, deposits. So different deposits we will be filling, that is demand deposits, saving deposit account, term deposit account, and the total. In schedule 4, borrowings, that is borrowings in India, that is given Reserve Bank of India 55. And in case of schedule 5, other liabilities, that is given 0.05. and schedule 6, cash and balance with the Reserve Bank of India, cash in hand is given, balance with the Reserve Bank of India. So we have to maintain the balance with the Reserve Bank of India, that is 2.25. How we have calculated like this. So it means that whenever we have to calculate 3% is calculated 22.305, and cash with RBI already is 18.94, and transfer needed to maintain cash reserve is 3.365. So we calculate like this, and after that there is a total. In schedule 7, balance with banks, money at call and short notice, we have filled all the data. So there is a balance with the bank in current accounts. So there will be an adjustment 75 point. So given is 77.935 minus the transfer needed to maintain, that is 3.365. So balance will be 74.57. So that was with the bank, and we will be using that amount. And similarly, after that there is schedule 8 investments. We will be filling all the informations in it, and the total is 82.7. Now advances. So there are different advances. Bills purchased, uh, we will be filling, that is nil. Cash credits, overdraft and loans 420, and there is 396.44, and total is 816.49. And there is specification that is given: secured by tangible assets, covered by bank, unsecured, etc., etc. So the balance is the same. In schedule 10, the data is given and just we have filled in it. Premises 78.4, and there is depreciation in the balance. And similarly other 35.45 and depreciation and the balance. And the total is 112.91. And there is no information regarding the other assets, so the schedule 11 is nil. And in schedule 12, there is contingent liabilities. We have given claims against bank not acknowledged, and similarly acceptance, endorsement, other obligations, and other items for bank is contingent liable, that is also given. That is not there, and the total is 7.335. So this is how we calculate the things. So the total of the demand and time liabilities becomes 743.56, and 3% becomes 22.305. SRR becomes 30%, 223.07. So we have already discussed this adjustment, that profit and loss balance before appropriation was 75 plus 205 in profit and loss, and minus statutory reserve. And liquid assets, the total of the liquid assets when we add these assets: cash in hand, cash with other banks, money at call and short notice, gold, government securities, and this becomes 345.77. So liquid assets are 345.77 minus we require 30% of the total dependent liabilities, 223.07, and balance, that is the excess liquid reserve, with us 122.7. And we will be using the cash with other banks, we have already discussed, and the amount or the transfer needed to maintain reserve is 3.365. Thank you very much. Sabka pala ho. May all beings be happy. Try it at home. Thank you very much.